Hello, my name is Benjamin Tan, and I'm the Securities and Education course, i.e. the SEC co-lead lecturer. SEC is student-led course run by the Investment Society, and welcome to the SEC Winter Special, which is the 20-minute condensed bite-sized version of the lecture for you to brush up on your knowledge in the winter holiday.
Hello, my name is Sebastian Stewart, and I'm the co-lead lecturer along with Ben. The SEC is a finance lecture series based on the CFA Level 1, covering a range of topics ranging from equities to real estate to FX and many more. This lecture series is ideal for beginners as well as advanced and intermediate students. We hope you enjoy listening to the podcast as much as we enjoyed delivering the lectures. Thank you for all those who attended the course this year. We had a record level of registration and hope to welcome more of you next year.
Hello everyone, my name is Rebecca Fayyad and I am the president for this year's Investment Society. And today I will be walking you through the first Securities and Education Certificates, i.e. the SEC course lecture. It's typically always led by the president, and we will be having a very quick overview of the entire financial sector. In the next lectures, we'll be going into much more details of a lot of things that I will be touching on today. So if you are interested in much more information on different sectors, then definitely stay tuned for future podcasts. Let's get started with the stock market. If we want to go back to the 1500s, to the East India Dutch trade, where there were merchants who were trading golds, spices, jewels, etc. across to the Americas. And what they used to do is that obviously because it costs so much to take commodities from one place to another and build a boat to transport them, they wanted to maximize the capacity of those boats. And what they did is that they used to go to investors and tell them, hey, if you give me some money for me to build a bigger boat and take more commodities, I'll be able to take them, trade them over in the Americas, and then give you a percentage of the money that you have given me as a profit. And this is literally how the first stock market came about. And what it is that on the stock market, you have what is called a security. And a security is a tradable certificate that has monetary value. So instead of having cash, which is literally money, a piece of paper, you have what we call a security. And under the security, we've got the biggest three types, which are equities, which is what you think about when you hear of Tesla stocks or Uber stocks or whatever stocks that you think about. This is what comes under equities. You have fixed income, which I'll be touching on later, and derivatives, which personally is honestly one of the most interesting things to ever dabble in, which I'll be talking a bit more about later. But within those, we have asset classes. And those asset classes are a group of investments that behave similarly. Within those asset classes, again, you've got equities, fixed income, forex, commodities, a few different ones that you can see and trade. And what makes them different is that whenever you're trading one, you're trading all of them kind of in the same way. So all equities are traded similarly, so are fixed income, forex, which is foreign exchange, and commodities. Now, let's very quickly go into those asset classes. Let's start with equities. Equity is literally a percentage ownership of a company. And what you do is that when a company goes public on the stock exchange, let's say the London Stock Exchange or the New York Stock Exchange, most countries have their own stock exchange, you're able to buy a share of a company in return for literally owning a bit of that company, which are all marked as a market value, which is the price that investors are currently paying to purchase that security. In that case, the stock. As mentioned, there's all the different stock markets, but other than the stock markets, there are also over-the-counter tradable stocks. And we cover this much more in depth in the lectures, but this means that they're settled between two parties without the supervision of an exchange. Moving on to fixed income, which I know I did say derivatives is very interesting to me, but fixed income is probably one of my favorites because what it literally is fixed income. So what they do is that, let's say a company wants to sell, I don't know how to do it in like a short way. Okay. Next, let's go into fixed income. What fixed income is that a company wants to sell you debt, right? So instead of going to a bank and asking for money, what they're going to do is come and ask you for money. And what they're going to say is that, hey, I want $1 million from you, and I'm going to give you the $1 million back in 10 years, which 10 years is the maturity rate. What they're going to do is that they're going to give you a fixed coupon rate as interest. So let's say you've got that 10 million in 10 years, and every year they're going to give you $200 as interest and what we call a fixed coupon rate. And so that's where the word fixed income comes, is that every year you're going to get a fixed income until you get all of your money back at the end of the maturity period. And this is where fixed income comes from. Next, I'll go super quickly over foreign exchange, which is also known as Forex or FX, which is literally just trading one currency to another. We will have a whole lecture about just this, so I won't go into more details, and we'll very swiftly move on to commodities, which is literally any item or substance for human use. So you can think oil, gas, copper, gold, lithium, and even a lot of experts are considering cryptocurrencies as commodities. Now, some people might also consider that as their own asset class, so it's up to you guys to decide what you consider it as. But what is very interesting with commodities is that you trade them with a financial instrument known as futures, which, long story short, again, we're going to go into so much details in a later podcast episode, but futures is where you pay a future value of a commodity today instead of later. And so depending on whether you think it's going to go up and down, you'll be able to set that price and then long or short it, which I'm going to go more into details on what that means. Now that we've gone through all of the asset classes, and which again, we will go into so much more details in later episodes, I'm now going to be giving you a very quick overview of the financial market from A to Z. So I hope I keep it under 10 minutes. So let's start with the main industry players. We've got 4 key players that work together within an ecosystem. We've got the sell side, the buy side, the central bank, and the regulators. I'm going to quickly go over the sell side vs the buy side because we're going to go into much more details into them later on. But to give you an idea, the buy side is literally what you would hear as asset manager, hedge funds, private equity, venture capital, all of these players that are buying something. Literally the buy side. They invest their money or investors' money into different asset classes that we've previously talked about before. And investment strategies define what kind of funds they are, which we'll be going into later on. Moving on to the sell side, think about investment bank. They're what we call the financial services companies. And what they do is that they literally sell their services to the buy side or to corporations. So what they do is that they advise, they lend, or they carry out transactions to raise money and acquisitions. Moving on very quickly onto the other 2 players within the ecosystem, the first one being central banks. Every country has its own central bank, so think the Federal Reserve for the States or Bank of England for the UK, and their main responsibility is to control inflation by adjusting interest rates or by quantitative easing and tightening. And we'll go into that a bit much later, but they work with regulators. So think of the Securities Exchange Commission or the Financial Conduct Authority in the UK. What they do is that they prevent market participants causing market manipulation. There's loads of really cool case studies that you guys can go into and kind of read about, but stay tuned for more coming up later, or come to our lectures next year where we'll be going through super interesting case studies where markets were manipulated. Now that we've gone through all the main players, let's zoom into an investment bank. Within an investment bank, you've got the private and the public side. The private side is what we think of as investment banking, where merger and acquisitions, also known as M&A deals, happen. And the reason that they're private is because if you know information about a certain deal happening, you'll be able to trade it and make a lot of money on it. And this is what we call insider trading. And it's incredibly illegal, and that's why we've got regulators in the markets. And it's also the reason there is a physical, what we call a Chinese wall between the private and the public side. The public side is what you think about when you think of traders, sales and trading, global markets. All of those words come on the public side. And the reason that there is a physical Chinese wall is due to compliance, because if the public side knows about what's happening on the private side, they'll be able to trade on it and make a lot of money, which is illegal. Very quickly, to go into what investment banking entails, you've got advisory, which is usually split into different sector teams. For example, TMT, healthcare, industrials. And what they do is that they use the four main valuation methods, which is discounted cash flow, public comparables, precedent transactions, and leveraged buyout, to look at a company and then put a monetary value on it for the sell side. And this is mainly what the advisory side does. Along with the advisory side, we've got the equity capital market, also known as ECM. And within ECM, you also have R&D, M&A, internal ECM, etc. And what the word comes from, equity capital markets, is when a company wants to give their equity out. And so, in other words, they want to IPO or get on the stock market. Similar to ECM, equity capital markets, we also have debt capital markets, DCM, which is when a company wants to raise capital by releasing bonds into public markets. As we previously discussed, FI, fixed income, this is exactly where it comes from. The final part of an investment bank is leveraged finance, also known as LevFin, which is when a private equity firm wants to acquire a company through a mixture of debt and equity. In the live SEC course, we'll go into much more details into all of those sections, but we will now be moving on to the market side. Moving on to the market side, as we called the public side as well, we've got the main part of it, which is sales and trading, where they sell and trade. Within sales and trading, you've got agency trading, which is when they execute trades on behalf of the buy side. Think hedge funds, asset managers, etc. Within that, there's market making, which is a very interesting part of sales and trading, which needs a lot of, let's say, if you're interested in quants or systematics, this is where you'll be going in, because just to give you a very quick overview of what it is, if you want to buy 10,000 shares of, let's say, Tesla, that will change the market price. And so what you need to do is buy them in different chunks to maximize the value of buying this bulk of 10,000 stocks. I won't be going into much more details here, even though I do want to say that there is something called the bid-ask spread, which I do recommend for you guys to look up. It is how traders and people in sales and trading kind of look at prices. It is very interesting, and we do cover it in the course, but I'll be moving on now into structuring. Structuring is another area under sales and trading, and what they do is that they create bespoke products for clients. So usually combining two or more products to match what the client wants. Working side by side with sales and trading are the equity researchers. And what they do is that they look at the market, at different companies, etc., and then create market updates and research papers on different companies and markets so that both the sell side and the buy side can look at and inform themselves of different decisions. We've mentioned the public, the private side, but I do want to mention one more thing, which is the tech side. If you have a background within scientific subjects and you're interested in combining your studies and finance, then the tech side is something that you definitely need to look into. All of these big players within investment banking, hedge funds, private equity, etc. do require people who work in tech. So whatever you're interested in, you'll definitely find a place for you. Now that we've looked at all the different sectors within an investment bank, I do want to mention that there are different types of investment banks. You've got your typical bulge brackets, which are the largest banks working on the largest deals. Think Goldman Sachs, Credit Suisse, Morgan Stanley, etc. You've got the middle markets, which work on smaller deals and smaller corporates and might even have services. So think HSBC, Standard Chartered. And then you've got elite boutiques, which are smaller firms that work on largest deals. So they're usually independent advisory, so they don't underwrite. And think Lazard, Evercore, Rothschild, etc. Now that we've looked at the sell side, let's very quickly go over to the buy side. Within buy side, we've got asset managers and hedge funds, where they manage large pools of money on behalf of clients. And the main difference between asset managers and hedge funds is that asset management focuses on long-only securities, whereas hedge funds look at long and short views on stocks. End-to-end, the buy-side players, we've got private equity firms that buy companies with loads of debts to increase their efficiencies and then either IPO with them or sell them to other market makers. And this is an overview of the buy side, which again comes in the context of the buy side, the sell side, how they work together with the central bank and the regulators. This was all for today. So we went through all of the asset classes and then we moved on to the main players, buy side, sell side, central banks, regulators. We zoomed into the sell side and then from the sell side went into the different divisions within an investment bank. And then from the buy side, we also looked at the main players. If you are interested in looking at a list of firms within those industries in order to apply, then the Investment Society has a folder specifically made just for this, for you to be able to check that directory and apply to them directly. Thank you so much for joining me today in our condensed version of the 2-hour lecture that we offer. I'm looking forward to meeting all of you, whether it's in person next year for the start of our SEC course, or we also offer our course online for students all across the world to join. Thank you so much and hope you enjoy the series.
Credit to our producers, Aaliyah Friedman, Lois Kim. Head of Marketing, Samhat Raman. Juniors, Ken Zhang, Angie Zhao. Head of Scriptwriting, Alfred Choi. Juniors, Aditya Muthakumar, Kwan Lin. Head Liaison, Lucrezia Poloni. Junior, Ekaterina Vitor. Head of Audio, Isaac Chu. Junior, Cyrus Lee. Head of Sponsorship, Sami Liu and Vladimir Dmitriev. Juniors, Leo Lee, Jamila Tabet, Utkarsh Jetling.